Hello friends, welcome to the special Saturday session of most important questions for ABM. In most important questions, we are covering those questions which are repeated in the exam, previous exams. So you'll be getting a sort of PYQs only. Kindly follow the video till the end, like the channel, subscribe to the channel, click on the bell icon. Do it fast because these numericals and these questions are very much important for you in the exam. Today I will be covering some important numericals which are asked previously in the exam. So watch it till the end. In fact, I would suggest everyone should watch this till the end. Complete session, you must watch this. Okay? Because this is very important. Every minute of this is important. Okay? So, various case studies are taken over here. Today I will be taking important case studies. So that's why I am saying watch it till the end. This case study was asked in earlier exams also. A bank has a loan portfolio to a company A. A bank has a loan portfolio to a company A of rupees 100 lakhs. So loan given to a company is 100 lakhs by some bank. Probability of default for the company A is estimated at 2%. And the loss given default is 40%. Means if I am having the loss, then if the company becomes NPA, then the loss for me as a bank is 40%. So now question, calculate the expected loss for this loan. How will you get the expected loss? If this question comes, this question might come for 1 mark or some additional question joint 2 marks. How to find the expected loss? Does anyone have the formula? Expected loss? Expected loss equals to, I will write EL only, okay? EL equals to loan amount, loan, into probability of default. So simple, into LGD. So simple. Loan multiplied by probability of default multiplied by LGD. So that is equal to what? What is loan now? Loan is 100 lakhs. 100 lakhs into probability of default is what? 2%. 2% into what is this? 40%. So calculate it. Calculate it. Kindly don't do it manually, okay? Try it with a calci. Always try it with a calci. Why am I telling you? Why am I telling you? Because don't try it orally. 40 to the 80. Don't do this 80%. Because you will go wrong in this. Whenever you are calculating percent, kindly note this. Whenever you are calculating percent, 100 lakhs into 2 upon 100 into 40 upon 100. See, upon 100 creates a lot of difference. So calculate it now. So 100 gone, 4 to the 8, 80 upon 100. So 80 upon 100, right? This is right now. 80 upon 100. So it is equal to 0.8 lakhs. This is in lakhs now. So it will be in lakhs. So 0.8 lakhs. Kindly don't miss out on the calculations. So what is the expected loss then? 0.8 lakhs. Okay. While doing the calculations, even I myself have done the mistakes over here in doing these calculations. Upon 100 we forget to 10 because we are dealing in percentage. Whenever we deal in percentage, we have to focus on upon 100. Okay. Next. Which of the following is not a primary type of financial risk faced by the banks? Not. Market risk, credit risk, liquidity risk, strategy risk. Financial risk. It should not be the financial risk. What is market risk? Market risk means any risk which is not in your hands. USA attacking somebody, Russia attacking somebody, China attacking somebody, and the oil prices rise. Not in your hands, but your financial loss will be there. financial risk will be there. So this is the part. So I'll just write not a primary type. So I'll write it primary type. Credit risk means I give the loan to somebody and that person never pays back. Never pays back. Default. So that is again the primary type. Liquidity. Liquidity risk means, see, liquidity risk just now we did, I think so in BFM also. Yeah, in BFM we did it earlier. So liquidity risk is mainly of three types. Kindly note. One is time risk, time. Okay, time risk. Second is call risk, call risk. And third one is funding risk, funding. Remember, although this is not the answer, but you have to remember the concepts. I am not here to just give you the answers and move on. The answer is simple, strategic risk. Answer is strategic risk. What is strategic risk? Strategic risk means your inability to focus on the long term. Inability to focus on the long term means what? There are many examples. You remember the phone Nokia phone? How many of you remembered Nokia phone? Everyone was having Nokia once in 2006 to 8. Every hand was having Nokia. Where is Nokia today? Do you have a Nokia phone? How many of you have Nokia phone? Just type. Yes. Everyone shifted to Android very fast. So strategic risk. Nokia should have thought of it. Okay. Number one. Some companies are there. Kodak company. You remember the Kodak mobile, not mobile, cameras? Kodak, Konica, Yashica. There were so cameras. Where are they now? Gone, isn't it? Theaters. Single run theaters means single screen theaters. Where are they now? Single screen theaters. Gone. Strategic risk. Long term thinking not there. Where the world is changing, you are not changing. If you don't change, you are gone. So that is not a part of your financial risk. This is a long term business risk. This is called as business risk. Okay? A bank faces the possibility of losses arising from the increase in the repo rates by RBI. Increase in the repo rates by RBI. RBI increases the repo rates, and because of this, bank might face the losses in, let's say, its bond portfolio. Because where will bank face the loss if the repo rates increase? Bank will face the loss in mainly bond portfolio. Okay? Of course, in loans also they will face, deposits also, but both will increase simultaneously. If repo rates increase, your deposit rate will also increase, your loan rate will also increase. So both will match each other. But the problem is in the bond rates. Bond rates go in the reverse direction. If my repo goes up, my bond price will go down. It is always in the reverse direction. Okay? So, this is an example of what? Market risk, operational risk, credit risk, reputational risk. It is an example of market risk. Market, because it's not in your hands. RBI should increase the repo rate or not. Is your bank concerned in that? Does RBI ask your bank, should I increase the repo rate? It will not ask. So whatever is not in your hands, but it affects you, is basically known as market risk. Right? So the answer is market risk. Okay, bank faces the possibility of losses arising from the increase in the repo rates. Let it be increase or decrease. Both the sides you can have the losses. Okay. Which among the following is not a micro level step taken in mitigation of credit risk? So which among the following is not a micro level step taken in mitigation of credit risk? Not. Pay attention to the question. Not. Okay. Don't get confused. In exam, I'll tell you, many of the students lose almost 6 to 7 marks only by not reading the questions. Read the question properly. Not is asked, not a micro level step. Improving sanctioning and delivering process, obtention of collateral security, monitoring and review of individual proposals, categories of proposals, periodical review of exposure limits for business or industry. Which of them is not a micro level step? Micro. What is micro? Kindly note, in banking there are 2 levels. Again, 2 levels. I'll give the clear bifurcation. Micro and macro. Macro. Okay? Micro and macro. Micro means what? Micro means branch level. Branch. I am very clear in this. Branch. Macro means HO. Head office level. At branch level, what do you do to mitigate the risk? Mitigate means reduce. What do you mean by mitigation? See, there are 2-3 words. Okay? One is, where is it? Mitigation. So, mitigation equals to reduce. Reduction equals to hedge. Hedging. Okay? All are one and the same. Either hedging the risk, mitigation of risk, reducing the risk, one and the same. So, at branch level, what do we do for reducing the risk? At branch level, what do we do is, number 1, we'll take a collateral. See, I won't write it now. We'll take a collateral. We'll do proper analysis of the loans. We'll do the management analysis. We'll check the persons behind the company. Okay? And legal documentation. All these 3 parts we'll be doing. And regarding macro level, it's at HO level. At HO level, what do we do? We do 2 things. One is diversification, very important. Diversification. You should not give the loans to a single sector. Okay, you should not give a loan to a single sector. Number 1. Number 2. What next? Derivatives. Okay, derivatives are an important part. Covering the risk. So, look at this. Review of exposure limits for the business. So, this is a part of what? This is a part of HO. Will this be done at HO level or will this be done at a branch level? The overall banking portfolio. Will a branch do this? No. So, it is a part of this. So, you want not. This is a part of macro, not micro. Got it? Clear? A bond has a Macaulay duration of 3 years. The current yield to maturity is 6%. We want to estimate the percentage change in the portfolio's value if the yield increases by 50 basis points. Original value of the portfolio is 120 CR. Find a new value. So there are 2-3 questions involved over here. Very important one and very, I would say, lengthy one also. Not that lengthy because Macaulay duration is already given. See, there are 2 durations. One is Macaulay, second is modified. Okay, Macaulay and modified. What is Macaulay duration? Macaulay duration means the duration in which, within the life of that bond, in which the interest rate risk on that bond becomes 0. Interest rate risk on the bond becomes 0. Macaulay. Modified duration means, see, I have taken this many times, that's why I am not writing. Okay. Modified, Macaulay, interest rate risk, interest rate risk equals to 0. Simple meaning. Okay, during that tenure. Modified means, modified is for 1% change in repo. In repo or any benchmark, in repo, percentage change in price of the bond. This is known as modified duration. Price of the bond or the portfolio, whatever it is. So in this case now, Macaulay is already given to you. First, you have to find out the modified duration. What is the formula for modified duration? Everyone? Modified duration equals to mod equals to Macaulay, Mac upon 1 plus R. Mac upon 1 plus R. Okay, Mac upon 1 plus R. What is Macaulay given? 3 years. 1 plus R. R is what? 6%. So it's equal to 3 upon 1 plus 0.06, 6%. Okay. So it is 3 upon 1.06. That is equal to, find this everyone. Find the answer. 3 upon 1.06 is, and this will be in percentage. Everyone do it using the calci. Yes, it is in percentage. Three upon 1.06, right? So 2.83, correct? So it is 2.83. Got it, everyone? 2.83. But this is in percentage. Percentage. What does it mean? It means that if my repo rises by 1%, the price of my portfolio or bond will fall by 2.83%. Will fall. In earlier numerical, I think so I shown you. So repo goes up, price of the bond will come down. Okay. So now what is given? What is given? We want to estimate the percentage change in the portfolio's value if the yield rises by 0.5 basis points. So now understand this. If repo rises by 1%, repo rises by 1%, my price will fall down by, 2.83%, right? 2.83? Yeah, 2.83%. So if my repo now rises by only, let's say 0.5, so this rises by 0.5. So again, this will also change, right? So 0.5 into 2.83 upon 1. 0.5 into 2.83 upon 1. Do it, everyone. 0.5 into 2.83 upon 1. 2.83 into 0.5. So what are you getting? 1.41? Are you getting 1.41, everyone? Are you getting 1.41? So this will change to, price will change, fall down by 1.41%. So first question which is asked is this only. If my yield changes by 0.5 basis points or 50 basis points, 0.5%, then percentage change in the portfolio will be 1.41%. But you are having one more question in this. See, there are two questions involved in this. One is this and second is find a new value. So now what is the new value? See, now this calculation is very simple. I'll show it over here. Okay. What was the earlier value? 120. Let's forget this crore now. Now this 120 will fall down by 1.41%. So that into 1.41%. Find this. Find the answer. 120 into 1.41%. Everyone. Okay. Remember, don't forget this percent. 120 upon 100. Upon 100 you should never forget. So 1.698. So roughly you can take it 1.70. Isn't it? What are you getting? 1.70. So it will fall 1.70. This is what? Crores. Because this was in crores. So this is in crores. 1.70 crores. Got it, everyone? So the value of my portfolio will fall down by 1.70. But what am I asked? Find a new value. So I have to get a new value. So new value will be 120 minus 1.70. Okay, so that is equal to 120 minus 1.70. So 119, 118.3. Yeah, 118.30 CR. This is the value of your new portfolio. So these are the two answers. These are the two answers, everyone. Got it? These are the two answers. Clear? So look at the levels of the questions. The questions are really difficult over here. This was the original question. We almost forgot the question. We are so much engrossed in solving this. So that's why remember, the questions in ABM as well as in BFM are difficult. Okay, I'm taking the regular YT sessions. Don't miss these. Now, let me show you the new batches which are coming up. Always join the Adda 24/7 batches through the app. In the app, you will be getting 1% extra. Okay, because app has coin systems that will give you. So that's why download it first and then join. Okay, go to Adda 24/7. Click on JAIIB and CIB. Look at this. Right now you are having CIB double increment, increment Mahapack. In this increment Mahapack, you are having double validity right now. Double validity means, look at this. You buy for 6 months, you get it for 12 months. Buy for 12 months, you get it for 24 months. So huge it is, isn't it? Plus discount part. Look at the discount. Put the code Y432. Remember the code Y432. Okay? You will get 79% off plus 1% extra plus double validity, and in this Mahapack you are getting 15 plus batches per subject. 15 plus 15. Huge it is. Okay, so join it ASAP. Also the new batches of ours will be coming up. Join them also, because the new batches will be right at the time of your exam. Okay, so join them. So bye, and never forget the code Y432.